You ever wonder how someone worth 10 million, 50 million, $1 billion pays next to nothing in taxes while you are sitting there watching a third of your paycheck vanish before you even see it? I used to think the same thing. I remember sitting at my kitchen table in 2017, staring at my W-2, my tax bill, and just feeling stuck. Like the game was rigged, but nobody handed me the rulebook. That frustration actually sent me down a rabbit hole that changed everything I thought I knew about money. In this breakdown, you are going to learn how the ultra-wealthy structure their finances legally to minimize taxes, why your W-2 income is the most expensive money you can earn, the specific vehicles and strategies they use that most people have never heard of, and most importantly, how you can start applying some of these principles at your own income level even if you are not remotely wealthy yet. Let me paint you a picture that used to make my blood boil. Jeff Bezos, Elon Musk, Warren Buffett, these names come up every year when ProPublica drops another story about billionaires paying effective tax rates in the single digits. And the immediate reaction is always the same. That is unfair, the system is broken, they must be cheating. But here is what took me forever to understand. They are not cheating. They are playing a completely different game than you and I were taught to play. The problem is not that they are breaking rules. The problem is that most of us do not even know the rules exist. I spent the first decade of my working life believing that income was income. You earn it, you pay taxes on it, that is just how it works. I was trading time for money, getting a paycheck, and watching the government take their cut automatically. I thought tax planning was something you did for a few weeks in March with some software or a cheap preparer. I had no concept that how you earn money matters infinitely more than how much you earn. And that ignorance was incredibly expensive. In 2018, I paid roughly $34,000 in federal income tax on about $110,000 of income. That is an effective rate of nearly 31%. Around the same time, I learned about a real estate investor in my area who made $400,000 that year and paid less than $8,000 in federal tax. Less than 2%. Same country, same tax code. Completely different outcome. That gap, that massive gap between what I paid and what he paid, that is the problem we are unpacking today. So here is the core secret, and I want you to really internalize this because everything else builds on it. The ultra-wealthy do not, I repeat, do not build their wealth through ordinary income. They build it through capital appreciation, business ownership, and strategic debt. And each of those is taxed entirely differently than your paycheck. Let us start with the single biggest concept. Buy, borrow, die. I know it sounds morbid, but this is arguably the most important tax strategy in America, and almost no regular person knows about it. Here is how it works in practice. Let us say you bought Amazon stock back in 2005. You put in $50,000, and today that position is worth $10 million. If you sold it, you would owe capital gains tax on $9.95 million. At current rates, that is maybe $2 million to the federal government. But you do not sell. Instead, you go to a bank and say, I have $10 million in stock. Let me borrow against it. The bank gives you a line of credit, maybe $3 million, at an interest rate of maybe 4 or 5%. You live on that borrowed money. And because loans are not income, you pay zero tax on that $3 million. Zero. You use a tiny portion to pay the interest, which might itself be deductible depending on use. Then you die. Your heirs inherit that stock at its current value, what is called a stepped-up basis. They could sell it immediately for $10 million and pay no capital gains tax at all. The loan gets paid off from the estate. Billions in appreciation, millions accessed for spending, and the tax man never got a meaningful cut. This is not a loophole in the sense of something shady. This is established law, used routinely. Now, you might be thinking, great, but I do not have $10 million in stock. Fair. But the principle scales. I have a friend, let us call him Marcus, who bought a duplex in 2015 for $180,000 in a mid-sized city. It is worth about $420,000 now. He pulled out equity through a cash-out refinance, not taxable. He used that to buy another property. His original down payment was maybe $36,000. He has accessed roughly $200,000 in equity through refinancing over the years, lived on some of it during a career transition, and has not paid a dime in tax on any of that money. When he dies, his kids get that stepped-up basis on all of it. Second major strategy. The business owner tax advantage. When you have a W-2 job, your income is taxed, and then you pay expenses from what is left. When you own a business, you pay expenses first, and then you are taxed on what is left. That sequencing difference is enormous. Let me give you a realistic example. Say two people each gross $150,000. One is a marketing manager at a tech company. The other owns a small marketing agency. The employee might have a handful of deductions. Maybe $10,000 if they are aggressive. The business owner can deduct legitimate business expenses. Home office percentage. Vehicle use. Technology. Continuing education. Travel that mixes business purpose. Meals with clients or partners. Health insurance premiums. Retirement contributions through a SEPA or solo 401k. It is not unusual for that business owner to show taxable income of $80,000 or even less on that same $150,000 gross. I have seen it personally. I helped a freelance consultant friend set up proper expense tracking, and her effective tax rate dropped from 28% to roughly 17% in the first year. She made the same money. She just kept more of it. The third strategy is where people start to tune out because it sounds complicated, but stay with me. Qualified Opportunity Zones. The 2017 Tax Cuts and Jobs Act created these to encourage investment in economically distressed areas. Here is the practical version. Let us say you bought Bitcoin early and you have $500,000 in gains. If you sell, you owe capital gains tax. But if within 180 days you invest those gains into a qualified opportunity fund that invests in designated zones, you defer the tax. Hold it 5 years, you get a 10% reduction in your original gain. Hold it 7 years, 15% reduction. Hold it 10 years, and any appreciation on the new investment is completely tax-free forever. I know a physician who sold a medical practice, had $2 million in gains, put it into a QOF developing affordable housing in South Carolina. 10 years later, that investment is worth $4.5 million, and that $2.5 million in new gain. Zero tax. The original gain was reduced by 15%. This is not theory. This is codified federal law. Fourth, and this one surprised me when I learned it. Charitable giving is a tax tool, but not how you think. Most people donate cash to charity. That is fine, you get a deduction for the cash value. But the ultra-wealthy often donate appreciated assets instead. Here is why that matters. Say you bought stock for $10,000, it is now worth $100,000. If you sold it and donated the cash, you would owe capital gains on $90,000, then get a deduction for what you donated. If instead you donate the stock directly, you get a deduction for the full $100,000 fair market value, and you never pay tax on that $90,000 gain at all. I started doing this myself once I understood it, on a much smaller scale. Donating appreciated index fund shares to a donor-advised fund, then distributing from that fund over time. Same charitable impact, radically different tax outcome. Fifth strategy. Life insurance as a tax shelter. This one sounds like a sales pitch, but bear with me. Permanent life insurance. Properly structured, grows cash value tax deferred. You can borrow against that cash value tax-free during your lifetime. And the death benefit passes to heirs income tax-free. I have spoken with estate planners who structure policies for business owners where the policy effectively replaces wealth that will go to taxes, or provides liquidity without forcing asset sales. Not for everyone, not cheap, but when you are looking at estate tax thresholds, it is a standard tool. Now let me share where I personally went wrong, because this is not about pretending I always knew this stuff. In 2016, I got a small windfall, about $45,000 from some contract work. I just took it as income. Paid self-employment tax, income tax, the whole thing. Effective rate hit nearly 40%. I did not know about S-corporation elections, which might have saved me roughly $6,000 in self-employment tax alone. I did not structure anything. I just cashed the check. That ignorance cost me about $15,000 compared to what I would pay today on identical income. The learning curve is expensive if you do not start climbing it. Let me give you some practical steps, numbered, that you can actually use based on where you are right now. 1. If you have any side income, any freelance work, any gig work, form a single-member LLC and elect S-corp status once you are consistently netting over $40,000 to $50,000 annually. This lets you split income between salary and distributions, potentially saving 15.3% in self-employment tax on that distribution portion. The exact break-even varies by state and situation, but this is foundational. 2. Open a solo 401k or SEPRA if you have self-employment income. In 2024, you can contribute up to $69,000 depending on your income structure. That is a deduction at your marginal rate. If you are in a 24% federal bracket, that is $16,560 in tax savings on the maximum contribution. Compare that to a regular employee 401k limit of $23,000. The gap is massive. 3. If you have appreciated investments in a taxable account, stop donating cash to charity. Donate the appreciated investments instead. Open a donor-advised fund if you want flexibility on timing grants. Fidelity, Schwab, Vanguard all offer them with low minimums now, sometimes as low as $5,000. 4. Learn the difference between recourse and non-recourse debt, and how leverage against appreciating assets works. If you own a home with equity, understand that a HELOC or cash-out refinance gives you access to capital without triggering taxable events. Use carefully, but understand the tool. 5. If you have significant capital gains, research opportunity zones directly on irs.gov. Do not rely on promoters. Understand the 180-day rule, the holding periods, and the requirements. It is not passive investing, you need to be deliberate, but the tax benefits are substantial if the underlying investment is sound. 6. Track everything. The wealthy do not have better deductions, they have better documentation. Every meal that had a business purpose. Every mile driven for work. Every subscription, every course, every conference. The deduction you do not claim because you did not record it is the most expensive mistake. Let me be realistic about results, because I promised no get-rich-quick nonsense. When I started implementing these strategies, my first year saw my effective federal rate drop from roughly 28% to about 19%. On roughly $120,000 in income, that is about $10,800 in savings. Not life-changing money, but significant. More importantly, that money went into investments rather than to the IRS, so the compounding effect over time matters enormously. A friend who owns 3 rental properties and a small consulting business, combined household income around $350,000, runs an effective federal rate of roughly 11% through aggressive but entirely legal structuring. Another contact with a $2 million annual income from a successful SaaS business, structured with a C Corp, R&D credits, and deferred compensation, pays an effective rate around 17%. These are realistic ranges. You are not going to zero. But the gap between 30% and 15% on a growing income base is the difference between retiring at 55 and retiring at 45, or between having options and feeling trapped. I want to be clear about something. This is not about dodging your fair share. Roads need paving, schools need funding, I am not arguing for zero tax. But the tax code is thousands of pages long, and most of it describes how to reduce your tax burden legally. That is not an accident. Congress intentionally incentivizes certain behaviors: business formation, investment, charitable giving, risk-taking in designated areas. The ultra-wealthy did not write those incentives for themselves alone. They just have the teams to read all 1,000 pages. What I am suggesting is that you read the relevant paragraphs for your own situation. If this breakdown resonated, if you are tired of feeling like you are playing a game where only the other side knows the rules, I would encourage you to hit the subscribe button and the notification bell. I put out deep dives like this every week because I genuinely believe financial literacy should not be gated behind expensive advisors and inherited knowledge. Drop a comment if you want me to go deeper on any of these strategies: the S-Corp election process, how to evaluate opportunity zone funds, whatever would be most useful. And if you know someone who is grinding on a W-2, convinced there is no other way, maybe share this with them. Not to make them feel bad, but because once you see how the game actually works, you can never fully unsee it. And that awareness, that first step toward financial self-education, is where real change starts. I will catch you in the next one.